Now let's continue with the final trading strategy. The third trading strategy also uses two time frames and combines the concepts of buy-side and sell-side liquidity, liquidity sweep, and fair value gaps liquidity, and activate those stop losses. This gives them enough selling pressure to fill their large buy orders. Also, breaking below this level will cause some sellers to jump into the market, thinking the price is about to drop further. But in many cases, after smart money grabs the liquidity, the price quickly reverses and moves higher. This traps both early buyers and breakout sellers. The same logic works in reverse for buy-side liquidity. If smart money wants to sell, they need buyers. So they push the price up above a key resistance level, trigger buy stop orders and breakout entries, and then reverse the price downward after collecting enough liquidity. With all that being said, some liquidity levels are more important than others. Certain criteria can help you spot the stronger ones. For example, liquidity around major swing highs and lows, higher time frame levels, or equal highs or lows tend to be more significant. Now let me show you how the third trading strategy works on the chart. First, mark the buy-side and sell-side liquidity zones on the chart. Then, wait for the price to break out beyond one of these zones, and then quickly close back inside the range. This shows a liquidity sweep, or false breakout, where smart money has collected the orders and is likely preparing to move the price in the opposite direction. Then, zoom into the lower time frame and look for fair value gaps that formed right after the sweep. These gaps show imbalance and can act as entry zones. If it's a bearish scenario, for example, after a sweep above a buy-side liquidity level, look for a gap and signs of a reversal. Once confirmed, you can open a short trade. Place your stop loss above the high of the sweep and target the next key level or sell-side liquidity below. Same concept applies to we focus on the sell-side liquidity below key lows. When the price sweeps this level and closes back inside the range, it signals a bullish liquidity grab. Then we zoom into the lower time frame and wait for the indicator to highlight a bullish fair value gap that forms right after the sweep. This gap is used as the entry zone. Enter a long trade from the gap, place your stop loss below the swing low, and target the next buy-side liquidity level. This simple process helps you trade with smart money, not against it. Remember, more trades does not mean more profit. Waiting for high probability setups to appear and filtering out low quality ones is a skill that takes time and discipline to develop. With all being said, if you'd like to use the price action toolkit with 15% off, make sure to check the link in the description. Thanks for watching, and see you in the next one.